So as you've now hopefully seen, mapping swing structure with the way that we do is, I would argue, pretty damn mechanical. Obviously, the only element of discretion with the way that we map swing structure is just what we deem to be significant enough of a swing pullback, okay? So super quick refresher. Let's say the swing structure is bullish. As soon as that swing high is broken, right, and we get the candle body closure above that high, we know straight away that the swing low is going to be the lowest point, right? I could do a bit more of a complex example, but we get the breaker structure here. At that point, we know it's not this low, it's not this low. It's definitely, this is the new swing low, right? Because it's the lowest point that broke the high. So you can code that. There's no if, buts, or maybes. It's 100% mechanical. Where it gets a bit discretionary is when we get that break of this high, right? And we're obviously forming a higher high. It's like, at what point can we draw on our swing high line? And the reason why that's important is because let's say price pulls back a little bit. You don't necessarily want to draw that on as your swing high straight away, because then if you do, if price then moves up and breaks it, right, that means you've had a swing breaker structure, which then means this is your new swing low, which then means if price breaks this low to the downside, now your swing trend is bearish. But if we just draw this on for a minute, it's just a bit visually easier to see. And then we'll put on some bosses. Let's use a thick line. Okay. So, like I was saying, right, when we got that little pullback there, if you marked that out as your swing high, and now you're saying that the swing trend is bearish, is it really bearish, or are we just pulling back into this larger low, right? Because I would argue, if it was something like that, like relative to the recent price action, that's just a pullback into this level. So now you're saying we're bearish, and if price comes up, then you could be looking to get short from here, but you're probably more likely going to be on the wrong side of the market because you'll think you're shorting like pro trend because you saw that as the last boss and you're looking to get short here. But I would argue that that's just internal or fractal breaker structure for price to pull back into the discount of this swing leg to then continue higher, right? So that's why it's kind of like important that you want to have, you want to be focusing on those larger swings. But obviously, it can help to be quite mechanical with this, especially in the beginning, until you gain a little bit more experience. So what you can do to define what you deem to be significant enough of a pullback when price pulls back to go, okay, now I'm happy to mark on my swing high, is you can use a pip rule. Where basically you would go, okay, we're on euro dollar and we're on the 4-hour chart. So for that pair on that time frame, let's say I'm going to make up a number here, you need to see 100 pip pullback. So after we get the boss, only once price pulls back 100 pips, okay, now imagine this is 100 pips, right? You can measure it. So if you hold down shift and click, you can do this and it tells you how many pips there are. So that says 1968. You need to put that last number as a decimal point. Okay, so if it says 1968, that's 196.8 pips, right? So let's say you're looking for 100 pips. That would be 100 pip pullback. Okay, obviously it's not great in this example, but that's when you go, okay, now I'm happy to now mark this out as my swing high, right? Because you have a fixed pip rule. So question then probably you're asking is, well, how do I come up with a fixed pip rule? Well, let me tell you the magic formula to finding out the magical pip rule of the market. You just draw it on with your naked eye, whatever you deem to be swing structure, just like we have done in the previous couple of lessons. And then what you do, like let's say you did it this way and you go, yeah, these all look like clear swings to me. This makes sense. Then go and measure every single swing pullback that you did, right? So again, hold down shift and then click, and then you can drag this up to where the swing high is. And there you go. What does that say? It says 4161. So it's 4. Remember that last number is a decimal point. So it's 416 pips. Okay. So you've measured that one. You could either just do this, go, okay, quick note with a speech bubble, go 416 pips. Okay. How big was this one? Exact same process. That was 190 pips roughly, right? So you go 190 pips. Now, what you want to do is you want to do that for about, 10, 15, 20 examples, recent examples, and just measure like what was the minimum pip size pullback you did. And let's say this was the smallest swing pullback you did out of all of them. You go, right, but my minimum size is 190. That now becomes your current rule. You'll go, right, for me to define a swing pullback on the 4-hour chart, so specific to that time frame and specific to that currency pair, you now know that you want to see at least 190 pips, okay? So what that will mean is, let's say we're at this point in the market, all right, and you've had your bearish swing boss and price is pulling back. You're like, okay, we're pulling back, but you can't put your pretty swing low circle or draw your swing low line across until what? Until prices pull back 190 pips, which as we know will be around here, right? So you know it's only once price pulls back up to here, at that point you go, okay, we've had 190 pip pullback now. Now I'm going to draw on my swing low line, right? That's what you can do. And that's essentially how your pip rules work. So again, how you come up with that is you have to do it with your naked eye first. Draw on just everything that looks to you with swing structure, right? It doesn't have to be perfect. And I'm going to explain to you in a later lesson where it doesn't matter if you're someone who likes to focus on the bigger swings, or maybe you're someone who likes to focus on the smaller swings. So like over here, right? After we got this break of structure, I didn't, in this instance, view that as a swing pullback. But some of you might think, no, that is a swing pullback, right? And all that means is then you would have that as your swing break, then your swing break here, and then your swing break here, okay? And that's fine. It doesn't matter, and I'll talk about this in a later video, right? The point I'm trying to make in this video is draw on what to you is a significant enough pullback, right? And then once you've done that, like we have done here for like, a decent amount of examples, just go and measure them. Go, okay, and find out what your minimum pip size pullback was. So this one was a little bit smaller actually. That was about 178 pips. And that can become your rule. And that's how you do it. But the key thing is you need to have a rule for each time frame that you use and for each individual instrument or pair that you trade, okay? And the reason why that is important is because, well, let's just think about one pair. Every time frame is going to move a different amount, right? This 180 pip pullback on, say, the daily chart, that's not going to be a swing pullback, is it, right? The daily chart probably going to want to see a lot more. On the M15, that's going to be, multiple trends. So it's specific to the time frame you're looking at and also specific to the pair, because the amount of volatility that each instrument has will always differ, okay? So people refer to this as the average true range, the ATR, and essentially that measures how many pips that instrument typically moves in a day, okay? So the average true range or the daily volatility of euro dollar, it typically is a bit more than Aussie dollar. Pound dollar, on the other hand, it moves way more in a day than euro dollar does, so it'd have a much higher ATR. So if you traded, let's say, euro dollar and pound dollar, you're much more likely to have a much bigger pip rule for pound dollar on the 4-hour chart compared to euro dollar, okay? So if you trade more than one instrument, you need to have rules. If you're going to do this, you need to have rules different for each one, but you just follow the same process, okay? So obviously that's a main drawback, is if you are someone who maybe trades a lot of instruments or you want to look at a new instrument, you're going to have to go through this process to find out what rule you want to use. A related drawback to that is that volatility also changes over time. So like if we go back to, let's say over here, right? These pullbacks on the 4-hour chart, these swings, well, how big is this? That's like 55 pips as a swing pullback. And back then, in 2021, like that's, I think I used, like a 40 pip rule for the 4-hour chart. And that worked absolutely fine because volatility wasn't as high as now. Well, now I'm looking at like hundreds of pips on the 4-hour chart because volatility has massively increased since 2021, right? So the way you come around this is you just need to adjust your pip rules every so often. If you notice that, let's say, like if you was in 2021, you used a 40 pip rule, but now obviously we're in 2022. And like, look at that, 40 pips is about there. That's clearly not a swing pullback now because volatility is way higher. So it will become obvious to you that you need to adjust your pip rules. And when that happens, okay, fine. Draw on the recent, just go through the same process. Draw on your swing structure on the recent price action and go, okay, what's the pip size rule that now makes sense? And there we go. It's nothing magic. It doesn't matter if yours is smaller or larger than someone else's, okay? Size doesn't matter in this instance. But yeah, and also you will see this in a later lesson. I'm not sure what I'm going to call it yet. Probably put it at the end of this module. Probably call it something silly like, does swing structure really matter? And in that video, I'll prove to you that it doesn't matter if you're someone who uses it smaller or tighter, because you're going to learn obviously the 3 types of structure. And when you combine that with multi-time frame analysis, it really won't matter, okay? And you'll see why at a later point. But just for now, I just wanted to show you one way in which you could make things 100% mechanical if you wanted to do it. But obviously there are some drawbacks to that, which we have discussed. Now, there may be some other methods that you can use. You may want to look into using something based on ATR, like a calculation based on volatility. I haven't played around with this. I haven't dug into it. I haven't tested anything like that because I've just found it completely unnecessary. I'm very happy to use a little bit of discretion with measuring swing pullbacks, and with a little bit of time and experience, I'm sure you'll be comfortable with that as well. Especially again, when you combine it with the 3 types of structure and multi-time frame analysis, you will soon realize when you understand that it really doesn't matter that much. Okay, so yeah, hopefully that makes sense. Don't be afraid to just draw it on of what makes most sense to you. Measure your pip rules, and again, don't be afraid to adjust them in the future if volatility does change.